In 2015, a welder named Juan Hernandez joined SpaceX. He had never heard of the company before. It was just another contract job for me at the time, he said later. When SpaceX brought him on full-time, they offered him $10,000 in company stock. He didn't think much of it. None of his previous jobs had come with equity, but he kept buying more with each paycheck for 10 years. When SpaceX went public in 2026, Hernandez owned roughly 6,500 shares, and when it hit the open market, those shares were worth more than $1 million.
SpaceX's historic IPO.
Largest IPO in history.
The biggest IPO the market has ever seen.
SpaceX opens at $150.
Still how it works, honestly.
First off, this isn't normal. Most investors don't hit it big in that way. It was only possible because SpaceX became one of the most valuable companies in history. Most early-stage private investments do not. Juan's story shows us something. Most of the wealth creation in successful private companies happens before they ever reach the public exchange. The IPO is often when early investors realize gains, not when new investors begin building them. That's where private markets come in. It's the difference between building wealth within a company versus when public investors can jump into the pool. We're going to talk about three things: what the private markets are, how they work, and what it means to you as an investor. Let's start with the basics. Most investors spend their entire financial lives in the public markets. They buy and sell stocks listed on a public exchange like the NYSE or NASDAQ. But those companies listed on those exchanges represent only a fraction of the actual opportunity. The number of publicly listed US companies has declined significantly since the 90s. Today, there are roughly 4,700 publicly traded companies. There are approximately 33 million companies in the private sector which aren't listed on public exchanges. That's a whole lot of growth and opportunity out of sight of the public markets. Let's break down the different asset classes in the private markets. These are the different opportunities you have as an investor to participate in the private markets. First, private equity. This includes funds that acquire ownership stakes in private companies. They typically work to improve operations and grow value over a multi-year holding period before selling them or listing them for an IPO. Next is what we call venture capital. This is the exciting stuff. It's when early-stage capital is deployed to startups and high-growth companies before they reach the public markets. SpaceX's early investors were venture capitalists. Third, private credit. This means direct lending to private companies. The returns can be higher, but capital is locked away for a longer period of time. Fourth, infrastructure. This is physical assets like toll roads, energy pipelines, data centers, and utilities. They tend to generate stable contractual cash flows that are farther away from the public markets. Finally, commercial real estate on the private side. This includes multifamily housing, industrial warehouses, medical office buildings, and senior housing, among others. 5 opportunity sets, each with a variety of risk and rewards for the investor. We deploy a portfolio approach, which means we invest in a multitude of companies represented by these jelly beans. These green jelly beans are the spectacular results which Juan experienced in SpaceX, or earlier examples could have been Apple or Google or Microsoft. Again, I have to reiterate that we're investing in startup companies in new technologies. Nothing is proven. So some companies will eventually work out and deliver decent enough returns. These black jelly beans and these yellow jelly beans represent that median company. Unfortunately, when you invest in new technologies, some technologies won't work out, will never reach commercialization. So let's just say several of the companies that you invest in will actually peter out. That's represented by these red jelly beans. I don't know 10 years from now which category my investments will fall in. The lesson isn't to invest in any particular company. It's all about portfolio construction. The math of venture capital is deliberately built around accepting some losses in exchange for a smaller number of very large wins. Juan Hernandez did not have a financial strategy. He had access and discipline. The reality is that most investors will never receive pre-IPO equity through an employer. But access to private markets is no longer limited to the employees of the right companies or the largest financial institutions. The question is whether your current plan is built to evaluate and, if appropriate, take advantage of it. At Trajan Wealth, private markets are just one part of a complete client strategy, alongside portfolio management, tax planning, and overall estate planning. A free financial assessment is a good place to start. The link is in the description. If this video helped you understand the private markets just a little bit better, like, subscribe, and share. And if you want to go a little deeper into how private markets can fit into a broader wealth strategy, take a look at the Trajan Family Office Advantage, also linked below. Thank you for watching, and I'll see you in the next one.